Welcome to this webinar hosted by the National Bank of Belgium. We are pleased to have you join us today as we present the newly released 2025 edition of our Financial Market Infrastructure and Payment Services Report, the so-called FMI report. Since 2017, the bank has published its FMI report annually in its current format. For the fourth consecutive year, we also organize a webinar along its release. My name is Samuel Goret. I'm the TIBER, TLPT, and Critical Infrastructure Resilience Program Manager at the National Bank of Belgium. Belgium is home to several key financial market infrastructure, custodians, payment service providers, and critical service providers. Through this report and webinar, we aim to keep you informed about the bank's role in oversight and prudential supervision of these entities. Additionally, as the role of the National Bank as enabler of increased IT operational and cyber resilience grows, we cover topics related to this subject in the report. The report provides a comprehensive overview of our activities in the past year, as well as regulatory and environmental developments that impacts our sector. It spans almost 100 pages and is available on our website since the end of last week. Given the extent of the report, we won't be able to cover every topic today, but we have selected 4 key areas to highlight. Over the next hour, my colleagues and I will guide you through the following subjects. Noémie de Guzman will present the EU DORA regulation highlights and some of its key aspects and initiatives that the National Bank of Belgium has taken to facilitate and monitor DORA compliance. Secondly, Philippe Saffer will talk about Euroclear. In response to Russian military action in Ukraine, Euroclear Bank was obliged by EU law to freeze Russian-owned assets held in its systems. Russia enacted its own measure, fundamentally disrupting Euroclear's bank operation in the region. Philippe will highlight the main points on this topic. Next, Reinout Stemerman will focus on Wero, a digital payment solution for and by Europeans. It is designed to simplify and speed up online, P2P, and in-store payment. Wero is a collaborative effort by major European banks and financial institutions aiming to roll out a genuine European payment solution, allowing European citizens and merchants to make seamlessly and instant payments all across Europe. Last but not least, Vincent Versluis will describe how the oversight framework on SWIFT is undergoing a major revision. He will explain the rationale for cooperative central bank oversight on SWIFT, in addition to highlighting the major changes to the framework which will become applicable to SWIFT in 2026. Before we begin, a quick note on logistics. We will first go through the presentations. A Q&A session will follow immediately afterwards. If you have questions during the presentation, please use the Q&A button you can see on your screen. We'll do our best to answer and address as many as possible within our allocated time. With that, let's begin with our first topic presented by Noémie on the new regulation DORA.
Good afternoon. I'm Noémie de Guzman, and I'm here to provide you a clear and high-level understanding of the evolving digital risks and a significant European response known as DORA. Digital operational resilience. To understand why this topic is so critical, we first need to look at the world we live in. The financial sector has become profoundly digital, and this brings incredible efficiencies, but it also opens the door to significant and evolving risks. And we see these across 4 key areas. First, cyber risk is growing. Attacks are no longer just frequent, they are more sophisticated, and their potential impact is greater than ever before. The financial sector is a prime target. Cyber risk is unique and particular because of the speed at which an event can crystallize, and also the sometimes deliberate objective to cause major disruptions. The potential scale of the shock the probability that a successful attack would occur, and also the constant change in modus operandi, with threat actors responding to countermeasures. And therefore, there is a growing importance for financial institutions to constantly continue developing and testing their capabilities, which are identify, protect, detect, respond, and recover. Second, we have supply chain risk. Financial institutions don't operate in a vacuum. They rely heavily on external technology providers, also including services such as cloud computing. And this dependency on a few large global players creates concentration risk. And this concentration risk is elevated due to a lack of substitutes and causes the financial entities to have a limited bargaining power, making it challenging for entities to agree on their access and audit rights or to define exit strategies. To illustrate the importance of supply chain risk, as we observed with the CrowdStrike incident in July of 2024, a failure at a single provider can cause widespread disruption across the entire economy. Added to that, geopolitical tensions can affect the likelihood of supply chain risks materializing. Third, we are on the cusp of new technological era with AI and quantum computing. And while these technologies hold immense promise, they also have the potential to create entirely new and unpredictable risks that we must begin preparing for now. And all of this brings us to the fourth point, an undeniable need for resilience. It's no longer enough to just protect against known threats. The financial system must be able to withstand and recover from disruptions, whatever they cause, to ensure the services we all rely on maintain available. So faced with this challenging landscape, the National Bank of Belgium, along with our European partners, has made cyber and IT risk management a top priority. This is not a new focus for us. We have a range of ongoing activities and tools to assess compliance with the regulatory framework and the adequate management of cyber and IT risks. For example, we conduct on-site inspections and continuous monitoring. We also run a program called Cyber BE. Cyber stands for Threat Intelligence-Based Ethical Red Teaming. In simple terms, ethical hackers are instructed to simulate a real and sophisticated cyber attack on a financial institution. And this is the ultimate test of their defenses and helps them find and fix weaknesses before criminals can exploit them. We also organize large-scale crisis exercises that simulate major disruptions, testing whether the entities in the sector can correspond effectively. And some of these activities are done in close cooperation in Europe. Cyber threats don't respect borders, so our response can't either. We work with the European Central Bank and other national authorities to ensure a strong and unified approach across the EU. While these activities are essential, the evolving threat landscape required a more powerful, harmonized, and legally binding response. And that response is DORA, Digital Operational Resilience Act. In today's financial sector, information and communication technology has become absolutely pivotal. It's no longer just a support function. It's at the heart of how financial services are delivered, from online banking and digital payments to algorithmic trading and cloud-based infrastructure. But with this growing reliance on digital systems comes a significant downside: increased exposure to ICT-related risks. As financial institutions become more digital and interconnected, the potential impact of cyber incidents, system failures, or third-party outages grows exponentially. These risks don't just affect individual firms. They can ripple across the entire financial system, undermining its performance, reliance, and stability. And there's a key point. Traditional safeguards like capital buffers are not enough. No amount of capital can fully protect an institution from the consequences of a major ICT disruption. And that is why we need to think beyond financial resilience and focus on operational resilience. And this shift in thinking is already reflected in the work of global and European regulators. Operational and IT risks have become central themes in the policy agendas of bodies like the Basel Committee on Banking Supervision, or the European Central Bank, the European Systemic Risk Board, and the European supervisory authorities. However, before DORA, there was a clear gap. Despite the growing importance of operational resilience, there was no consistent or harmonized regulatory framework across the EU. Best practices existed, but they were fragmented and not uniformly applied. DORA was designed to close that gap. It provides a unified, robust framework to ensure that all financial entities, regardless of their size and sector, are held to the same high standards when it comes to digital operational resilience. So DORA, the Digital Operational Resilience Act, is a binding EU regulation. It's accompanied by a directive which amends existing financial legislation to align with DORA's requirements. What makes DORA stand out is that it's not just another set of guidelines or recommendations. It's hard law, directly applicable across all EU member states without the need for national transposition. This is a major shift from the current patchwork of supervisory expectations, circulars, and best practice guidelines. DORA is also cross-sectoral. It applies to a very broad range of financial entities, from banks and insurers to crypto asset providers, investment firms, pension funds, and even third-party ICT providers. In total, it covers around 20 different types of financial institutions. The regulation is also very detailed and demanding. It sets out comprehensive requirements, many of which are further specified through so-called Level 2 texts. Level 2 texts are secondary legislation that provide more detailed rules and technical standards to implement and operationalize the main regulation. They are crucial because they translate broad obligations into concrete and actionable requirements for financial entities. These requirements can cover several key areas. First, there's ICT governance and risk management. Financial entities must have robust internal frameworks to manage ICT risks effectively. Second, there is incident reporting and information sharing. DORA introduces harmonized rules for classifying and reporting ICT-related incidents, and it encourages secure information exchange between entities. Third, the digital operational resilience testing. This includes advanced testing methods such as threat-led penetration testing, or TLPT, which is aligned with frameworks like Cyber EU. And finally, ICT third-party risk management. One of the most significant innovations here is the introduction of direct EU-level oversight for so-called critical third-party providers, or CTPPs, such as major cloud service providers. And all of this became enforceable as of the 17th January 2025. So that's the date when DORA officially came into application. So in short, DORA is a game changer. It replaces fragmented soft law with a unified and binding framework that raises the bar for digital resilience across the entire EU financial sector. To support the implementation of DORA, the National Bank of Belgium has taken a number of preparatory actions. First, on policy development. We've been actively involved in shaping the Level 2 texts and integrating DORA into the Belgian legal framework. The level 2 texts are crucial because they translate high-level obligations into operational, technical, and procedural requirements. Meanwhile, nearly all level 2 documents have been adopted and published. Only one still remains to be published. Second is that we have focused on sectoral awareness and readiness. We have organized seminars, issued questionnaires, and encouraged self-assessments to help financial entities understand and prepare for DORA's requirements. Third is that we have updated our methodologies and training, and this includes revising our on-site inspection procedures and IT risk questionnaires, and sharing knowledge across teams. Fourth, we've developed new IT tools and processes to collect and disseminate information from registers for third-party arrangements and incident notifications. And finally, we're also preparing for our role in the oversight of critical third-party providers, including participation in joint examination teams at the EU level. In July 2024, the bank also conducted a self-assessment survey to gauge the sector's readiness for DORA. We received 132 responses from a wide range of financial entities, including significant and less significant institutions, insurers, payment and electronic money institutions, and central securities depositories. And the results were encouraging. Most entities reported significant efforts towards compliance, and many expected to meet the requirements by the application date of January 17, 2025. This could be due to the alignment of DORA with already existing regulations. However, the survey also identified important challenges and gaps, which we'll explore next. In the area of ICT risk management, some entities were still finalizing their policies and procedures, mapping ICT assets to critical business functions, implementing encryption and segmentation, and enhancing detection capabilities remain ongoing priorities. Third-party risk management is another area where work is still needed. Many institutions were renegotiating contracts to include audit rights, exit strategies, and visibility into subcontractors. And when it comes to digital resilience testing, some entities were still building their testing strategies and governance frameworks. Testing for severe but plausible scenarios, such as cyber attacks of third-party failures, was not yet fully embedded across the board. Now that DORA is in force, we are closely monitoring how financial entities are addressing the remaining challenges. The bank is actively following up to ensure that all entities are not only formally compliant, but also operationally resilient. Because resilience is not just a goal, it should be a standard. And with this, I conclude and leave the floor to my colleague, Philippe Saffer.
Hello, my name is Philippe Saffer. I'm an advisor on financial market infrastructures. And today I will provide you with some insights on our activities on Euroclear Bank, and especially with a focus on global sanctions and Russian retaliatory measures. First, I have to give you a bit of a broad overview of Euroclear Bank's Russian nexus. Maybe first, taking a step back, so Euroclear Bank is a CSD, a Central Securities Depository, that safeguards financial instruments and also settles transactions in financial instruments. Euroclear Bank is located in Belgium and has activities across the globe. In a first phase in Belgium, there has been the adoption of sanctions against Russia. Those have been enacted in the EU, the UK, the US, and broadly speaking, the G7. This has led to the immobilization of assets of the Central Bank of Russia and at the same time freezing of assets held by NST on the books of Euroclear Bank. NST is a Russian CSD, so responsible for issuing domestic Russian debt and providing, just like Euroclear Bank in Russia, settlement of transactions in financial instruments. Important to notice that it is very typical for such CSDs to create cross-border links, so domestic investors find access to assets in other markets. At the same time, Euroclear Bank is also offering services to a large number of central banks where they are a client at Euroclear Bank, just like the Central Bank of Russia. Now, the adoption that has led to immobilization and freezing has led to retaliatory measures in Russia in the second phase. Euroclear Bank is also connected to the Russian market and is providing services for the international investor community by having access to the Russian market by being client at NSD, that Russian Central Securities Depository. That has led to freezing of assets of Euroclear Bank and effectively the assets of the international community in Russia in NSD, and in a second phase has also already led to seizure of assets. More on that in the next slides. Now, important also is that Russia is enacting these type of measures with a focus on what they call non-friendly countries. In this slide, I'm providing a bit more of an overview on the risks that Euroclear Bank is being faced with, and I will also give briefly some insight on the windfall profits. So if we look at the high-level risks for Euroclear Bank, the first one that comes to mind is operational risk, human error, which could lead to claims against Euroclear Bank and or fines by sanctions authorities with potential reputational impact. A second, which is very important, is litigation risk in Russia and also potentially in Russian-friendly states, where underlying non-sanctioned clients, which are actually client at NSD, which has frozen accounts at Euroclear Bank, seek release of assets frozen by the EU, US, and other countries that enacted sanctions. Another type of litigation risk comes from Western investors that have assets being frozen within Russia and that are trying to seek compensation for Russian seizures without compensation. Now, the Russian countermeasures were constructed in such a way that they also instructed Euroclear Bank to take assets from their frozen accounts to compensate the international investors that have lost assets being seized, trying in such a way to net or to offset the exposures, but there is no certainty that in the future the same type of compensation measures can be implemented. We also had to implement at EU level changes, provisions, let's say in the sanctions law, to make such compensation mechanisms possible. Another risk, which is heavily discussed in the media, is potential EU G7 seizures of Russian assets, also specifically those of the Central Bank of Russia. On those, we are continuously pointing to very important risks which should be continuously considered, such as the role of the euro as a reserve currency, the certainty of EU asset protection regimes, so a key point on that is sovereign immunity, and preparedness for additional Russian countermeasures which could impact financial stability. Also those which are related to potential nation-state cyber attacks. Another widely discussed topic in the media has been windfall profits and micro-financial assistance loans for Ukraine. Because of the asset freeze, Euroclear Bank was making extraordinary and unexpected profits on its reinvestments of immobilized deposits of the Central Bank of Russia. This was fairly quickly noticed by the political public. This has led to decisions at political level to allocate windfall profits to Ukraine as of mid-February 2024. In a second phase, the G7 agreed on a system to provide loans to Ukraine, given the necessity to have a need for funding as quickly as possible and as much as possible. Those loans have been backed by a mechanism so that those loans will be paid back indirectly using the windfall profits made by Euroclear Bank, and has led to a total of $50 billion loans which have been provided to Ukraine by mid-2025. Now I would like to highlight the NBB's role in the current geopolitical context. We have different roles, one being oversight of the security settlement system of Euroclear Bank. We are continuously evaluating whether EB can provide assurance to uphold asset protection rules, to ensure that securities held on behalf of clients are safeguarded from legal and financial risks to the point possible, taking into account the application of sanctions and retaliatory measures. And we are also assessing EB's observance, as I have pointed out before, on its compliance, let's say, with the guidance on cyber resilience, given the risk for nation-state attacks. We are also a supervisor of Euroclear Bank, which is licensed as a financial institution and accept deposits for settlement activity. Very important topics that we scrutinize there are internal governance setup, making sure that there is the adequate escalation of risks, monitoring, and adequate level of decision making. We look at the financial health, meaning the balance sheets, how credit risks are being managed, liquidity risks, operational risks as well, which could lead to losses. Overall, we are looking at all risk management practices and are trying to make sure that Euroclear Bank is as resilient as possible to deal with external shocks, including legal, reputational, and operational risks. As I said before, we're also deep diving in capital and liquidity buffers, making sure that there is enough buffer to deal with the heightened level of risk and uncertainty, including those due to Russian retaliatory measures. Our third role is a supervisor of Euroclear Bank as a central securities depository, meaning providing settlements and safeguarding services, and on top of those also auxiliary banking services. Because of this license, Euroclear Bank is limited in the amount of financial activity that it can provide and should be focused on its core role as financial market infrastructure. So for those, there are very specific CSDR-related credit and liquidity requirements that we monitor, assess, scrutinize, including very strict reinvestment policies that they have to apply. Because, of course, the freezing of Russian deposits has led to a substantial increase of Euroclear Bank's balance sheet and reinvestment activities. There we are closely monitoring to make sure that decisions minimize credit and liquidity risk. Taking into account these three roles, at the same time we are also fostering a shared awareness with EU and international regulatory authorities and key central banks. We are trying to create a shared understanding of emerging risks, enabling regulators, supervisors, overseers, central banks across jurisdictions where Euroclear Bank is active to make coordinated and well-informed assessments and decisions. Finally, I would like to come to a few conclusions. it is of utmost importance that Euroclear Bank has the ability to adapt and maintain operational integrity amid asset freezes is critical not only to the stability of Belgium, the EU, but the global financial system, given its activities across the globe. NBB's role in overseeing and supervising is essential given our public mandate to pursue systemic stability and market confidence. The NBB is very committed to cooperation and information sharing across EU and global regulatory networks, having regard to the global systemic importance of Euroclear Bank. As FMIs become progressively more intertwined with geopolitics, central banks and regulators will be increasingly integrating geopolitical risks into their oversight and supervisory activities. With this, I will give the floor to Reinhard for the next topic.
Good afternoon, everyone. Good afternoon, everyone. So my name is Reinhard Timmerman, and I will talk to you today a bit about Wero, a new payment solution. So a bit of a background for those of you who are not familiar with Wero yet. Wero is the commercial name of what is actually the European Payments Initiative, or EPI in short, and I will refer to it going forward as EPI. It was founded in 2020 by banks and by payment service providers across Belgium, France, Germany, and with Dutch banks joining 2 years ago. Now, EPI acquired recently the Dutch payment solution called Ideal, which is probably very well known to most of you, as well as the Luxembourgish Payconiq International. So that will result in a phase out of Payconiq in Belgium, ultimately. France later on migrated its own Paylib solution to Wero. Now, the objectives of EPI or Wero are multiple. First one, and I think the most important one, and the reason we're discussing this today, is to create a pan-European and sovereign European-owned payment solution, which will give us a possibility to end the European reliance on non-EU card or mobile-based payment solutions such as Visa or MasterCard. Today, when Europeans make payments cross-border in another member state, we still use cards which are branded Visa or MasterCard. Ultimately, these are non-EU owned companies. So Wero is a step forward on trying to achieve strategic autonomy in payments in the European Union. And crucially, Wero builds on the new or relatively new instant SEPA credit transfer scheme that allows you to provide account-to-account payments, so between two bank accounts. This started already today with peer-to-peer payments, and EPI's ambition is to extend this into e-commerce as well as mobile commerce going forward. So let's talk a bit about what Wero does, both here in Belgium and elsewhere in the European market. So Wero essentially provides an ecosystem that combines two things. First of all, an account-to-account payment scheme, which is based on the four-corner model, very similar to the cards model, as well as a digital wallet secondary. So in the Belgian market specifically, for those of you who are in Belgium, Wero services are available basically in the mobile banking apps of the major Belgian banks. Think about Fortis Bank, Belfius, ING, KBC, which allows you as a potential customer of one of these banks to send and receive funds instantly through either scanning a QR code or entering a phone number of your intended recipient of the payment. Secondly, in the Belgian market, they have a strategic partnership today with Bancontact Payconiq company. And as I mentioned in the previous slide, there will be a gradual migration of Payconiq transaction volumes to Wero, which will ultimately result in Payconiq phasing out of the market in Belgium. Now, Wero concretely consists of three things. So Wero is a payment scheme, which means that banks and non-bank payment service providers can join the EPI scheme when they adhere to the rules and the standards that have been set out on technical level on how these payments ought to occur. Only when they adhere to the scheme, to the API scheme, can they offer a Wero payment to me and you as a customer. A second part is about the front-end solution. So Wero is also a front-end solution because it provides its services either indirectly through integration in the existing mobile banking applications of banks who are members of Wero, or they do it through their own standalone mobile app that you can download in Google Play or in the App Store. And third of all, EPI is also a technical platform where it provides shared services for its members. Think about fraud prevention, transaction processing, back office, and data management, of course. So that brings us to the question on how is Wero supervised or regulated. So EPI company, which operates Wero, is both supervised from a prudential point of view under PSD2, and it is subject to central bank oversight. So let me explain these two angles of supervision or of regulation. So first you have the prudential supervision, where basically Wero's standalone mobile app that I just mentioned, which is used to initiate payments to a particular beneficiary. And also you can consult your payment history, transactions you did, as well as the account information, your balance, etc. The framework in place today, the Second Payment Services Directive, considers this type of activity to be a regulated payment service called payment initiation and account information. An EPI company has obtained a license here in Belgium from the National Bank of Belgium to provide such services. So they are being supervised under PSD2 by the National Bank. A second part is the central bank oversight. So that's where the NBB has its cap, so to say, of a central bank overseer, and where EPI company operates the Wero scheme. Remember I said Wero is crucially, first of all, also a payment scheme. So that scheme, those set of rules and standards and technical requirements are also subject to central bank oversight. And to ensure that those rules and standards, that scheme meets these oversight expectations in every country where EPI offers or will offer its products. So to that end, the NBB has also set up what we call a joint oversight team with the central banks of the Netherlands, Luxembourg, France, then Germany, as well as the European Central Bank, which is involved as well. That brings me to the end of my presentation. So I'd like to give the word now to my colleague Vincent. Thank you.
Thank you, Reinout. During this presentation, I will provide an overview of the oversight framework that is applicable to SWIFT, as well as some upcoming changes that are expected to take effect next year. Let's start setting the stage by underscoring the importance of SWIFT as a critical provider of messaging services to the worldwide financial sector. The main application used to transmit these financial messaging services is called FIN. Each year, SWIFT transmits approximately 13.5 billion FIN messages, and that corresponds to around 53 million messages per day. SWIFT connects nearly 12,000 financial institutions across more than 200 countries and territories. These financial messages facilitate a wide range of financial activity. The most prominent use case is cross-border payments through correspondent banking. But SWIFT also supports next-to payments, securities transactions, as well as treasury and trade operations. Apart from individual institutions, such as banks, over 230 financial market infrastructures, or FMIs, around the world rely on SWIFT for their own operations. This includes both high-value payment systems like RTGS systems, real-time gross settlement systems, as well as low-value and real-time retail payment systems. All of this to underscore the importance of SWIFT, illustrating the need for direct oversight on SWIFT. The sound functioning and operational continuity of SWIFT is critical given the extent to which other financial players rely on its services. So I'd like to take a moment to clarify what we mean by oversight in this context, as it is a distinct concept from regulatory supervision. So oversight is rooted in a specific central bank objective, promoting financial stability and ensuring the smooth functioning of payment systems, rather than focusing solely on the prudential soundness of individual institutions. And even though SWIFT is in itself not an FMI, its services are so integral to the functioning of other payment systems that central banks have a strong interest in ensuring its operational reliability. And in recognition of this critical role of SWIFT, an international cooperative oversight body was established in 2004 by the National Bank of Belgium, which acts as the lead overseer as SWIFT is headquartered in Belgium. The arrangement in place brings together the National Bank of Belgium, as well as the G10 central banks, including the European Central Bank, in a coordinated oversight framework. In practice, the NBB has a formalized oversight relationship with SWIFT through an oversight protocol, a document that sets out the oversight expectations for SWIFT's operations and risk management. The protocol is complemented by bilateral memoranda of understanding between the NBB and each of the participating central banks, including the ECB. And in 2012, the SWIFT Oversight Forum was established. This includes the central banks of the G20 jurisdictions. And this oversight body ultimately enables the participation from a wider set of central banks whose domestic financial systems and economies also heavily depend on SWIFT's continued and reliable functioning. So let's have a closer look at the actual oversight expectations, which are structured along the 5 high-level expectations, or HLEs. And these HLEs were developed and endorsed by the G10 senior-level overseers, and they are embedded in the CPMI IOSCO's principles for financial market infrastructures. Since SWIFT is essentially an IT service provider delivering specialized services to the financial sector, the main focus of oversight is assuring operational risk management, business continuity, and overall resilience. And the expectations are set out against 5 high-level expectations. HLE 1 and 2 are about management of risk. So they cover SWIFT's general approach to how they manage risk and ensure that relevant information is communicated with its global user community. HLE 2, 3, and 4 correspond to types of risks. And as you can see, those are information security, reliability and resilience, and technology planning. So what we've just discussed provides a brief overview of the current oversight framework that is applicable to SWIFT. And this oversight is based on moral suasion. This means that it relies on the cooperation of the institution, in this case SWIFT, to meet the oversight expectations. Even though this approach has proven valuable in the past and effective, in recent years we have observed that there are some global trends whereby oversight approaches are increasingly converging with actual supervision practices. And there are a couple of drivers which can explain for this evolution. First of all, the regulatory environment. There has been an expansion of regulatory requirements. We touched upon a couple of those already in this webinar that are applicable to banks, insurance companies, and FMIs. And even though SWIFT is, again, a service provider rather than an FMI, the systemic importance that I just explained calls for a level playing field, meaning that SWIFT should also be able to meet the assurance standards that are applicable for other regulated players, even if through oversight rather than actual regulation. From a technology point of view, there has been a tendency for many companies, including SWIFT, to move away from legacy proprietary technologies to open source, standardized or cloud technologies. And this evolution even though it brings obvious benefits, also carries with it new risks, which warrant closer inspection and additional guarantees, and those are easier to attain through a legal backstop. SWIFT has also been expanding its product portfolio, where new services sometimes compete with offerings from other players who are already regulated, and this also calls for a level playing field. And then, as we already discussed, and the audience is probably aware of, SWIFT also in recent years has been forced to comply with EU sanctions legislation, leading to the de facto disconnection of a couple of sanctioned financial institutions from its network. And having a legally enforceable framework would allow for these types of measures, or at least for overseers to have structured discussions on these sanctions and to look at the broader risk implications of those geopolitical risks. So the outcome of all of these drivers have caused the G10 cooperative oversight body to start looking at legally underpinning the SWIFT oversight framework and making it ready for these future challenges. This exercise that started over 2 years ago has ultimately resulted in a Belgian law, which was passed by the Belgian Parliament on the 24th of April of this year, and which imposes a set of legally enforceable provisions for providers of financial messaging service. So let's take a look at the main principles which were endorsed by the G10 central bank overseers. So the current collaborative and consensus-building approach that we have for SWIFT oversight has been very valuable, and that will maintain to be the case in the future. We will also maintain the existing organization of oversight bodies consisting of a technical tier and a senior level tier. The main focus of the new framework remains operational risk management and the resilience. Although there has been a substantial expansion in the scope of the oversight mandate, we will touch upon that later, including things such as governance and access to information. These have been inspired by the principles of financial market infrastructures, and we selected those which best aligned with the oversight expectations and could be implemented into hard law. The most significant consequence of the law will be ultimately that today's moral suasion will be replaced or will evolve in a set of legally enforceable oversight expectations. The NBB in this arrangement will remain to be the lead overseer with ultimate responsibility for enforcement of this law. So then let's take a look at the changed scope of this oversight framework. As I mentioned earlier, the major change or innovation in this oversight framework is on governance requirements. So SWIFT, or at least the institutions which will be subject to this new oversight law, will be obligated to establish a two-tiered governance structure, including a supervisory board, which will be responsible for setting the company's overall strategy and for overseeing the management board, and then also the management board, which runs the day-to-day management of the company. To strengthen these governance standards, the law sets criteria to ensure the independence of supervisory board members and introduces term limits for their mandates. The supervisory board will also carry the ultimate responsibility for the establishment of a risk management framework, which is also in line with best practices. Furthermore, fit and proper assessments will be introduced for independent board members, which is also in line with practices that are already applied today to financial institutions and many FMIs. The revised framework also introduces criteria for conflicts of interest framework and establishment of a whistleblowing procedure. So, as mentioned earlier, risk management and business continuity remain at the core of the current oversight arrangement. This focus will continue going forward. The law, however, also codifies some specific operational risk expectations in greater detail. And this development has been inspired partly by the EU's Digital Operational Resilience Act, which sets requirements for financial institutions. And finally, the law also contains provisions to ensure access to information at SWIFT. and to facilitate information sharing with relevant stakeholders. This will ultimately reinforce transparency and the supporting of effective oversight. I will conclude this presentation by elaborating on the next steps towards implementation of this new law and establishing of the revised oversight framework. As mentioned earlier, the law has been enacted by the Belgian Parliament and will come into force at the start of 2026. SWIFT is expected to be designated as a systemically important provider under the criteria set out in the law. Following its formal designation and notification by the National Bank of Belgium, the legal provisions will apply to SWIFT 6 months thereafter, likely during the course of 2026. SWIFT is currently preparing to comply with the law's requirements, and overseers are actively monitoring its compliance roadmap in the lead-up to enforcement date. And we ultimately believe that this legally underpinned oversight framework will equip overseers to effectively manage oversight in the evolving environment we just discussed, ensuring continued resiliency and stability well into the future. Thank you very much for your attention, and we will now be taking questions.
Thanks, Vincent, and also the authors, of course, for providing highlights on these interesting topics. So more details on this, as well as other topics and insights, can be found in the report hosted on our website, www.nbb.be/fmi. We will now move to the Q&A. The first question is the following one for Noémie. What is the consequence for a financial entity if it's not compliant with DORA?
Okay, thank you for the question. Of course, if there are rules, it's always good to know what if you don't comply. So DORA compliance is it's not optional. It's really a legal obligation. So failing to comply can result in regulatory and also financial or reputational damage. National competent authorities and EU supervisors, they could issue warnings or orders to correct non-compliance. They could also impose restrictions on certain ICT activities or request remediation plans or actions or audits. And while DORA itself doesn't really set specific fines, it requires member states to establish effective and proportionate and dissuasive penalties. Also, non-compliance could lead to a civil liability in case of service disruptions or data breaches. Also, a loss of trust from clients or partners, or also investors, and also increased scrutiny from regulators and auditors.
Thank you, Noémie. The next question we have is for Philippe about Euroclear. Could the use of profits from frozen assets to help Ukraine set a precedent in the international finance?
Yes, it could. The decision to channel profits from frozen assets into micro-financial assistance for Ukraine is quite a novel move. Might inspire similar mechanisms in future conflicts or crises, raising questions about the balance between sovereign immunity and financial neutrality.
Thank you, Philippe. We also have a question for Reinout. Will WeHo become a truly pan-European solution? Because now it's only used in Belgium and neighboring countries.
Yes, thank you for this question. So WeHo does indeed envisage to become an actual pan-European payment solution, and to that end they are actually today in discussions with the Southern European Europa project, which is prevalent in Italy and Spain, for example. So yes, the idea is indeed to become as pan-European as possible.
Thank you, Reinout. Next we have a question for Vincent about SWIFT. Will SWIFT be classified as a critical ICT third-party provider under DORA? And if it is not, how will you ensure resilience and cyber risk to be handled under the new framework and regulation?
A very relevant question. SWIFT will in fact not be classified as a critical ICT third-party provider under DORA. In fact, the DORA legislation today recognizes the cooperative oversight body that is already applicable to SWIFT and therefore exempts that from the legislation. However, I indicated earlier that the DORA expectations formed a large inspiration to the oversight law that will now be going into effect, presumably as of next year. I also want to point out that the many institutions which are customer at SWIFT, they have to do their own proper monitoring of their ICT third-party providers. So presumably they will reach out to SWIFT in the near future with their own compliance questions relating to DORA requirements. SWIFT is aware of that and is also on the preparing accordingly to provide for such customer requests, and we are also following that up from an oversight perspective.
Thank you, Vincent. I believe this ends our seminar on the 2025 edition of the FMI report. Thank you all for your attention and see you next year.